Have you ever looked at your retirement account and thought, I've worked hard, saved diligently, and now I finally get to enjoy it all, but the IRS still wants a piece of it? If that sounds familiar, you're definitely not alone. Hitting 73 is a big milestone, but it also comes with a not-so-subtle reminder from Uncle Sam. It's time to start taking your required minimum distributions, or RMDs. Now, I get it. Just the name, required minimum distribution, sounds like one of those overly complicated, bureaucratic terms meant to confuse us. But don't worry. Today, we're going to break it down together, in plain language, and I promise it'll make a lot more sense by the end of this video. Think of this like sitting at your kitchen table with a good friend, coffee in hand, figuring things out together. No pressure, no judgment, just a real conversation about something that can have a big impact on your financial life from here on out. So, what exactly is an RMD? In simple terms, when you reach the age of 73, the government requires you to start withdrawing a certain amount of money from your retirement accounts each year. Things like traditional IRAs, 401ks, and similar tax-deferred accounts. Why? Because all those years you were putting money in and watching it grow, you weren't paying taxes on it. And now the IRS says it's time to start collecting. But here's the thing. If you don't take those withdrawals, you could get hit with a pretty steep penalty. As of now, that penalty is 25% of the amount you should have withdrawn. That's not a slap on the wrist. That's a chunk of your savings disappearing just because the rules weren't followed. And I don't know about you, but I'd rather keep that money in my pocket, not send it off to the government. So, how do you know how much you're supposed to take out? That's where the minimum part comes in. The IRS uses a formula based on your age and the balance of your account at the end of the previous year. They have a table, kind of like a cheat sheet, that tells you how much to withdraw based on how old you are. The older you get, the larger the percentage of your account you're required to withdraw each year. For example, let's say you turn 73 this year and you have $200,000 in a traditional IRA. Based on the IRS's table, your required distribution might be around $7,500 for the year. That money gets added to your taxable income for the year, which means you'll owe income taxes on it, just like it was a paycheck. Now, if you're thinking, well, I need that money anyway to cover expenses, so I'm taking it out regardless, that's great. RMDs won't change much for you. But if you are planning to leave that money invested or you didn't really need it right now, this rule might feel a bit frustrating. Still, there are ways to be smart about it, and that's exactly what we're going to explore. Some folks, for example, choose to make what's called a Qualified Charitable Distribution, a QCD. That means you can send your RMD, or a portion of it, directly to a charity of your choice, and that amount won't count toward your taxable income. It's a great way to support a cause you care about and reduce your tax bill at the same time. That's what I call a win-win. Another smart move? Timing. You don't have to take your RMD in one big lump. You can spread it out across the year if you'd like. Some people take monthly distributions to mimic a paycheck, while others wait until the end of the year to see how things look. Just make sure you've taken out the full required amount by December 31st. Otherwise, remember that penalty. And one other thing to keep in mind is that your first RMD, the one you take the year you turn 73, actually has a little wiggle room. You have until April 1st of the following year to take that first distribution. But here's the catch. If you delay, you'll end up having to take 2 RMDs in the same year, one for the previous year and one for the current year. That could bump up your income and your tax bracket, so it's something to think through carefully. Now, this might all sound like a lot, I know, but you don't have to figure it all out alone. There are tools, calculators, and even financial advisors who specialize in helping people just like you navigate these decisions with confidence. And remember, this is your retirement. You earned every dollar in those accounts. And while the rules might feel like they're getting in the way, understanding them gives you the power to make smart, intentional choices moving forward. Let's keep going, because now that we've unpacked the basics of what RMDs are and why they matter, it's time to dive deeper into how you can handle them in a way that protects your finances and your peace of mind. Now, Once you've wrapped your head around when RMDs start and why they matter, the next thing to consider is exactly how they're calculated and how that calculation can affect your annual income and even your taxes. So, here's the deal. The amount you're required to withdraw each year isn't just a random number. The IRS uses something called a Uniform Lifetime Table, which basically looks at your age and a life expectancy factor. You take the value of your retirement account at the end of the previous year, divide it by that factor, and voila, that's your RMD for the year. Let's break that down into something more human. Suppose you turn 73 this year and your IRA was worth $100,000 at the end of last year. Based on the IRS table, your life expectancy factor might be around 26.5. Divide that $100,000 by 26.5, and you'd need to withdraw roughly $3,774 for the year. And yes, that withdrawal will be counted as taxable income, which means you need to be mindful of how it stacks up with your other sources of income, like Social Security, pensions, or any part-time work you might still be doing. What's tricky here is that a larger RMD could bump you into a higher tax bracket, especially if you have multiple retirement accounts or if you're drawing from Social Security at the same time. That's why it's important to not wait until the last minute to figure this stuff out. RMDs are one of those things that sneak up on you if you're not paying attention. And another thing that catches people off guard is having multiple retirement accounts. If you've got more than one traditional IRA, for example, you have to calculate the RMD for each one. But you can withdraw the total amount from just one if you want to. That flexibility can be helpful. But if you have a 401k or 403b on top of that, those RMDs have to come out of each individual account. You can't mix and match. And if you're still working at 73 and you have a 401k with your current employer, you might actually be able to delay that RMD, but only from that specific account. So here's a tip. Get organized. Take stock of all your retirement accounts, know which ones require RMDs, and make a list of deadlines. The IRS expects you to take your RMDs by December 31st each year, starting the year you turn 73. There's a special exception the first time around. You can delay your very first RMD until April 1st of the following year. But that means you'd be taking 2 RMDs in one tax year, which can have a serious impact on your taxes. And let's be honest, no one wants to give more to the IRS than they have to. Now, you might be wondering, can I just reinvest my RMD or put it into another retirement account? And that's a great question. The answer is, unfortunately, no. Once you take that money out, it's considered ordinary income and you can't roll it into another tax-deferred account like an IRA. But you can certainly invest it in a taxable brokerage account or even use it to purchase things like dividend-paying stocks, bonds, or mutual funds, depending on your financial goals and what you want your money to do for you in the next 5, 10, or 20 years. Or maybe you've already got enough set aside, and the idea of paying more taxes on money you don't really need doesn't sit right with you. That's where something called a qualified charitable distribution can really help. With a QCD, if you're over 70 and a half, you can donate up to $100,000 each year directly from your IRA to a qualified charity, and that amount counts toward your RMD without being added to your taxable income. It's a win-win. You satisfy the IRS, you help a cause you care about, and you potentially lower your tax bill. Not bad, right? It's little strategies like these that make a big difference. Because RMDs aren't just about doing what's required. They're about understanding how those rules play into your larger financial picture. The more informed you are, the more power you have to make the choices that are right for you, your family, and your future. So, if you're 73 or getting close, don't let this stuff sneak up on you. The sooner you take action, the more control you'll have. So now that we've walked through how RMDs are calculated, how they're taxed, and how to manage them across different accounts, let's talk about something just as important: how to make RMDs work for you, not against you. Because yes, you're required to take the money out, but that doesn't mean you can't use it strategically. For some people, RMDs can feel like a burden, especially if they don't need the extra income. Maybe you've lived frugally, maybe you've got other income streams, maybe you just don't have a lot of big expenses. But here's a different way to think about it. This is your money. You've earned it, you've saved it, and now it's coming back to you. So the question becomes, what do you want to do with it? Some folks use their RMDs to spoil the grandkids a little. Maybe it's helping with college tuition, or sending them to summer camp, or just handing them a little envelope on their birthday that makes their eyes light up. Others put the money toward travel, one of those bucket list trips they've always dreamed about. If that's your style, now's the time. But if you're the type who prefers to stay financially sharp, you can absolutely use your RMDs to reinvest, just not in another IRA. You can open a brokerage account and put that money into mutual funds, dividend-paying stocks, or even short-term bonds, depending on your risk tolerance and what you want your money to do for you in the next 5, 10, or 20 years. Or maybe you've already got enough set aside and the idea of paying more taxes on money you don't really need doesn't sit right with you. That's where something called a qualified charitable